Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about WBD. We're diving into the definitive agreement that was announced on December 5th, 2025, concerning Netflix's acquisition of the studio and streaming assets from Warner Bros. Discovery. This is the behemoth of a transaction, valuing the enterprise at roughly $82.7 billion. And, well, it's fundamentally reshaping the media landscape overnight.
And the market's immediate response was, nothing short of manic. We saw WBD stock just launch from its depressed lows into the current trading range of, approximately $25 to $26? And crucially, it's trading at this persistent, pretty significant discount to the headline $27.75 offer price. And that's for the cash and stock part alone.
That persistent discount, that gap in the pricing, that's precisely where our debate lies today. It's important to note the volatility, leading up to and right after the announcement. We saw some really anomalous behavior in the market microstructure, specifically off-exchange short volume ratios. They spiked, hitting nearly 50%, 47.47% to be exact, on December 1st. That level of short activity right before a massive price jump is, it's highly unusual.
The numbers are extraordinary, yeah.
So the central question is this: does the current market price of WBD, trading below that stated minimum value, represent an unjustified and, temporary arbitrage opportunity that smart money should be exploiting? Or is this discount a perfectly rational reflection of the immense regulatory and structural risk that's just baked into the deal?
I'm going to contend that the price is rational. I think the market is correctly factoring in a very high probability of failure, mainly due to antitrust concerns and the frankly toxic nature of the debt-laden entity that WBD shareholders are being forced to retain. That risk premium is entirely justified.
And I'll be arguing that the structure of this deal has established a highly defensible financial floor, that $27.75 offer is a hard anchor, and it signals that the current discount is merely a pricing inefficiency that sophisticated, event-driven investors can capitalize on with a pretty favorable risk-reward profile. Let me begin by detailing why I believe this discount is temporary. My position really rests entirely on the clarity and the defensive structure of the financial consideration. The headline price of $27.75 per share. It's not just a nice round number. It's segmented for maximum stability.
I'm listening, but I still think deal certainty is going to outweigh price structure every time.
Well, we have two layers of protection here. First, $23.25 per share is fixed cash. That is certain immediate value, pending only the closure of the deal's cash portion. It's non-volatile. Second, the remaining $4.50 per share is protected stock consideration. It's tied to the performance of Netflix stock, yes, but it is protected by what we call a sophisticated collar mechanism.
That's a good distinction to make, but a sophisticated mechanism doesn't just make a regulatory review disappear.
Of course not, but the collar is essentially an insurance policy for WBD shareholders. The mechanism pegs the value of that $4.50 stock component so that unless Netflix's volume-weighted average price, the VWAP, falls below $97.91 or rockets above $119.67, which is a fairly wide buffer, the shareholders protected from moderate volatility. This creates a remarkably predictable arbitrage window. The ARBs can dynamically hedge their Netflix exposure, knowing the value of their payment is secured against all that market noise.
I agree the collar exists, but arguing it provides sufficient protection fundamentally ignores the existential risk posed by the debt structure. A $4.50 collar doesn't matter much if the SpinCo equity goes to zero and just wipes out any perceived premium.
I would also point toward the market microstructure leading up to the announcement as, clear evidence of institutional conviction. Pre-announcement, unusual options activity. This is the smart money positioning itself was highly bullish. We saw aggressive call sweeps, specifically large institutional buys on the January 15th, 2026, $25 calls, executed when the stock was still trading significantly lower.
Those buys certainly signaled something was coming, yes.
I'll give you that.
And even more compellingly, we saw aggressive short put selling. For example, the November 21st $19 put saw its open interest just skyrocket. You had institutional desks selling protection well below the current trading range. This established a clear, well-funded institutional floor. The smart money wasn't just guessing. They were placing huge, highly leveraged bets, signaling they saw this exact price increase, this exact floor coming. That speaks to closure probability, not to deal failure.
I see the options activity as proof that the easy money has already been made. But let me give you a completely different perspective on the valuation here. My court argument is that the current price correctly factors in the toxic nature of the remaining assets, which makes the total implied theoretical value completely misleading.
So you're focusing on the SpinCo, Discovery Global?
Exactly. We're told the theoretical value of WBD is somewhere between $30.75 and $34.75, right? That accounts for the Netflix component plus the value of the remaining linear networks. But the fact that WBD is trading significantly below $27.75 alone, that signals that the market views the value of that remaining entity, Discovery Global, as either negligible or, frankly, negative. The two-step structure of this transaction is incredibly precarious. It involves spinning off Discovery Global, which holds the linear assets, CNN, TNT, HGTV Eurosport. This new entity is going to be saddled with a massive chunk of WBD's gross debt, projected by analysts to be somewhere between $30 and $40 billion.
$40 billion is an alarming number, especially for assets that are facing a long-term secular decline.
That debt load translates to a really dangerous leverage ratio, estimated around 4.3 times EBITDA. For a growth company, maybe 4.3x is acceptable, but for a declining linear television assets, that is the leverage ratio of a zombie asset. It means the equity value of the Discovery Global share, which, remember, WBD shareholders are forced to accept, could easily be near zero. Or maybe just an option on survival, as you said. The market is rationally discounting the overall theoretical value because we're inheriting what is essentially a toxic waste dump of debt.
Okay, let's move to the primary obstacle then, which is regulatory risk. You argue that the risk premium is fully justified by these overwhelming antitrust hurdles.
Absolutely. The merger faces massive political and antitrust headwinds from the Department of Justice and the Federal Trade Commission. Netflix, the undisputed #1 streamer, is combining with HBO Max, a top-tier player. Regulators will almost certainly present this as a horizontal merger, creating massive concentration and pricing power that hurts consumers.
That's a common reading of the situation, I agree. But the vertical argument is strong here.
And beyond the consumer angle, there is the powerful monopsony argument, a term the current FTC leadership absolutely loves to use. It means reducing the number of competitive buyers for labor, specifically from the WGA and SAG-AFTRA. If Netflix and WBD merge, you reduce the negotiating power of writers, actors, and directors because there are fewer major studios to sell their projects to. This is a very sensitive political issue right now, and that risk alone justifies the price discount.
I acknowledge the intense political scrutiny. Look, the $5 billion breakup fee Netflix is willing to pay if the deal is blocked, that underscores that this is a recognized high-risk environment. However, the counterargument is robust. Netflix and WBD will meticulously present the merger as vertical and complementary, a distributor acquiring content production assets.
That's the classic defense, isn't it?
But they will frame it as necessary integration to compete with the real Leviathans, with Apple and Amazon, whose market caps and global reach just dwarf even a combined Netflix-WBD entity. Furthermore, we have to look at the fine print, the net debt adjustment clause. This provision heavily incentivizes WBD management to protect that 23 to 25 fixed cash payment from being reduced. And they do that by loading the maximum possible debt onto the SpinCo entity. The fact that management structured the deal this way suggests, to me, a profound confidence in their ability to close the cash portion, even if the regulatory review is prolonged.
But confidence in the cash portion closing and confidence in the entire deal closing are two fundamentally different probabilities, especially when you factor in the increasing political weaponization of antitrust.
Let's circle back to the microstructure for a second. I want to address your point that the easy money has been made. The volume on announcement day, that massive short volume spike, nearly half of all trades being short, was, I would argue, the signature of professional risk arbitrage desks setting up their very precise pair trades.
While I'll concede that professional hedging was certainly underway, that doesn't really explain the sustained volatility we're seeing today.
Hedging all the uncertainty. The high turnover volume, we're talking hundreds of millions of shares changing hands. It represents a massive transfer of ownership away from generalist and retail investors and to dedicated event-driven funds. They buy the spread because based on their models, the risk-adjusted return is compelling. This sustained buying pressure, despite the noise, it speaks volumes about institutional conviction in closing the deal.
That's a compelling argument for the ARB desks, sure. But you have to consider the geopolitical dimension that's driving the current volatility. The easy retail money that bought the low, the so-called gain-porn investors, they are long gone. The volatility we see now is driven by the dynamic arbitrage spread plus genuine political risk adjustment.
And what specifically is driving that political risk adjustment now, in your view?
Well, speculation is rife regarding potential regulatory intervention based purely on political motivations. I mean, given the losing bidder, David Ellison of Paramount, is deeply tied to prominent political donors, and CNN, a key linear asset in WBD's portfolio, is often a political target, the current administration or a potential future administration could use regulatory scrutiny to favor a specific outcome or to punish perceived media bias. The current price volatility is a reflection of constant risk adjustment based on these high-stakes political uncertainties, which are far harder for any arbitrage model to price than simple antitrust law.
That level of political risk is certainly difficult to model, I agree. And it does speak to why the market demands a discount. But let's return to the valuation component and the role of the spin-off, Discovery Global. This is really the elephant in the room that prevents the stock from touching that $27.75 mark.
The danger of that entity cannot be overstated, and this is where the market's skepticism is most rational. As we established, the net debt adjustment clause incentivizes War Media Management to load the maximum legal debt $30 to $40 billion onto SpinCo just to safeguard the Netflix cash. So shareholders who hold WBD are essentially exchanging their stock for a high-quality cash and stock component, plus a deeply leveraged ticket to a linear media entity with revenues that are rapidly decaying.
It is a forced exchange.
It is. So why would a rational, long-term investor knowingly accept an asset that carries that much debt on declining revenues, an asset that analysts are calling an option on survival, possibly valued at zero equity? The market is pricing in the reality that the premium portion of the deal is erased by the toxic risk we inherit in the SpinCo.
I think the market is reacting to complexity here, something WBD shareholders have done before. You have to remember the history. The creation of WBD itself involved a very complex tax-efficient structure, the Reverse Morris Trust, back in 2022, which the market consistently struggled to value and understand. That historical confusion between, complex tax-driven structures and simpler transactions like a reverse split that always creates a temporary discount.
But complexity doesn't negate debt.
Agreed. But here, the SpinCo is the necessary evil required to unlock the massive unencumbered value of the core assets, the studios, DC, HBO, and the combined streaming synergy with Netflix. That upside is truly transformative for the industry. While the SpinCo is inherently risky, the potential zero-value outcome of Discovery Global is already largely factored into the current $25 price. If the market truly believed the total value was $34, it would be trading significantly higher. The discount you see is the explicit cost of inheriting that risk.
And I'm not convinced that the market has fully discounted the risk of having to carry $40 billion in debt on an entity with declining revenues. If that spin goes sideways, if it needs restructuring or files for bankruptcy, it becomes a massive distraction and a liability for the shareholders who received those shares, even if the primary Netflix merger successfully closes. That persistent distraction warrants the spread we're seeing.
So, to summarize my perspective, the clarity of the financial terms, the $23.25 in fixed cash, and the protected collar on the stock portion, combined with the strong evidence of pre-deal institutional buying, indicates that the odds narrowly favor closure. Despite the legitimate regulatory and structural hurdles, the current spread represents an attractive risk-reward profile for the patient, event-driven investor who focuses on the strength of that financial anchor.
And my conclusion remains that the deal's structural fragility, primarily the deliberate debt shift to the Discovery Global entity, combined with the extreme political and antitrust risks of merging the number 1 and number 3 streaming services, it means that betting on closure is a low-probability, high-risk wager on defeating what could be a hostile DOJ or FTC. The current discount is simply fair compensation for those elevated risks.
We both fundamentally agree that Warner Bros. Discovery is no longer trading on its fundamental earnings power. It is trading entirely as a probability-weighted arbitrage scenario. The fate of the stock and the viability of the current price rests almost entirely on regulatory approval.
Indeed. The market is pricing profound regulatory skepticism. And based on the structure of this deal, I believe that skepticism is warranted.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.